I'm James Wagner, and today we're talking about insurance. Now, the subject of life insurance for many of us is like a trip to the dentist. Necessary, but not fun. The prospect of buying a life insurance policy that pays out death benefit is too close a look at our own mortality. Yet at the same time, none of us wants to leave our families financially insecure when we die. This is why it's critical to have sufficient life insurance. The most typical reason for purchasing life insurance is to help ensure your spouse and dependents have sufficient funds to maintain their lifestyle. To determine how much is needed, consider these questions, for example. What lifestyle do you want to provide to your spouse and family? This is a question that goes back to the very basics of our budgeting and planning process. If we knew exactly how much our current lifestyle costs, then we could make adjustments based on factors such as where will the surviving spouse live, as well as other lifestyle issues. And we must not overlook the inflation factor, and this is very important. What existing debts do we have to be paid? Sometimes the best use of life insurance is to pay off mortgage debt, college loans, or other responsibilities taken out over the course of a lifetime. What other income sources will the surviving spouse have? Add up pensions, Social Security, and income from trusts. The true value is sometimes called forced savings, because like a bank account, the premiums that you earn represent a return such that the benefits paid by the life insurance company should exceed the amount paid by the insured. Doesn't that make sense? It does to me. There are many different types of life insurance policies available, and the one that you choose must be based upon your specific needs. There are endless number of ways that insurance companies have found to make money on the inevitable. The most common is the whole life policy, and that tends to be one of the most expensive. However, it does offer a so-called cash value. The cash value builds over time and can be accessed by the policyholder as a source for borrowing. And the nice thing about these cash value loans is that the interest is generally reasonable and the loan never has to be paid back. That's not bad. However, the insurance company will deduct any unpaid balances from the benefits that they pay your beneficiaries at the time of your death. So keep that in mind. There are hybrids of the whole life, which are cash value of the policy is used to pay the premium for the policy. Very ingenious. Under certain circumstances, the cash value may be sufficient, whereby the policyholder has little or no out-of-pocket premium to pay. That's always nice. Next, let's take a look at term insurance. Term insurance is at the opposite end of the cost spectrum, and for this reason tends to be quite popular. Coverage limits can vary from life to periods such as 10, 20, or 30 years, for example. Now, this is especially popular policy when there's a need to provide protection, say for a business or for other reasons. Okay, let's just take a moment to address the next most important question. At what age should you begin buying life insurance? The younger you are, the less expensive the premiums that you pay. The older you are, the more expensive the policy becomes. The truth of the matter is, from a total cost point of view, it really doesn't matter. Now, that's not what the insurance companies would like to tell you, but that's the reality. If you live to the ripe old age of 95, you will pay the same amount for identical coverage no matter if the policy is written at age 25 or 45. There are several differences, however, to keep in mind. The longer you wait, the higher the monthly premiums. So even though your lifetime total may be the same, you will have to pay it off faster, and that means higher monthly totals. Over time, your health and thus insurability may change. So the longer you wait, the greater is the likelihood that you may be required to take a physical exam. If that reveals any condition that the life insurance company deems possibly to affect your life expectancy, they're likely to charge you, that's right, a higher premium. For most of us, forecasting our financial condition 20, 30, or 40 years into the future, well, it's impossible. If you're like me, it's hard to forecast 2 weeks into the future. What may seem like a large amount of coverage at age 25 when your earning power is just starting to build will likely well underestimate the future. So here are some practical suggestions. 1. Start with as much whole life as you can afford. Many insurance companies offer guaranteed insurability options that protect against unpredictable changes in your health. 2, after age 40, consider term insurance as it is nearly always less expensive than whole life. 3, use term insurance to cover large debts, such as your mortgage, your spouse's car, college tuition debts, things like that. Use whole life to create a forced savings program, money that can be left to a surviving spouse or family member. Okay, let's move over to disability insurance because this is something that not a lot of us know about. Usually not unless we need it. And if you've ever known anyone who has been involved in a serious accident that left them unable to work, you understand how disastrous this can be. Those who become disabled can apply for benefits through the United States Department of Health and Human Services. However, the amount of benefits that you're entitled to receive will depend upon a number of factors such as partial or total disability, income earned in periods prior to the disabled, and other factors. However, for most people, the amount received is a fraction of their former wages. The best way to cover this risk is with disability insurance. Ideally, it will supplement disability received from government programs. Before looking into private insurance, check your company's Human Resources Department to determine if you may already be covered. If you are, that'll take a lot of the worry out. Companies that engage in activities where employees are exposed to on-the-job risks, things like construction, utilities, and things like that, oftentimes include this as the standard benefit package. If not, you need to take your own risk assessment. Disability insurance is an additional cost, and your occupational and leisure activities need to be taken into account. If, for example, you work in an office 5 days a week and collect stamps in the quiet of your home on the weekends, you probably are in the lowest priority category. However, all of you professional rodeo cowboys out there, well, you're at the other end of the risk spectrum, so be careful. Before making any decisions, first take a look at your risk. Most people in this country are not covered by private disability insurance, but ask any of the millions of uninsured disabled and they will provide you with the best reason to have coverage. Well, that's all for this session. I'm James Waggoner for Professor It. See you next time.